Right, so that is November 2020, question 4. Let's retake the question. Tamu Limited is a company that manufactures biscuits. The following trial balance was extracted from the books of the company as at 31st March 2020. So we're given their sales, bidding at cost, and also the accumulated depreciation. We have land, retained profits. We have plant and machinery, office equipment, motor vehicles, and also the accumulated depreciation for plant and machinery, office equipment, and the motor vehicles. We have general administrative expenses, interim dividends on preference shares. Interim dividends, those are dividends paid in the midst of the year. Then we have bank interest, we have factory power, we have office salaries, insurance rates, advertising expenses, we have rent, maintenance, that is for plant, director's salaries, heating and lighting. We have bank, and that bank balance ukiangalia iko on the credit side. That means it was an overdraft. Yes. We have purchases of raw materials. We have return inwards. We have transport expenses, manufacturing wages, that is the direct labor. The manufacturing wages, that is the direct labor. We have allowance for doubtful debts. Then we have inventories, that is the opening inventory as at 1st April 2019 for raw materials, work in progress, and finished goods. We have accounts receivable and accounts payable. We have ordinary shares, each at 50. We have 10% redeemable, preference shares, each at 300. So we have now the additional information. We can go and tackle one by one as we interpret them. Number one, accrued expenses. Accrued expenses as at 31st March 2020 were as follows. We say that accrued expenses, we treat them as liabilities, and we adjust them at the end of the year by adding them back to the original amount of the expense given in the balances. So we have additional information one. Additional information one, we have accrued expenses, and that is these accrued expenses. We have said that they are liabilities and current liabilities for that case. So we have heating and lighting. Heating and lighting, that is 3642. 3642. So we adjust heating and lighting by adding 3642 to the balance given in the trial balance, which is 180, 342. So we adjust it with 3642. We add accruals at the end of the year. We add, so this one will give us an amount of 183, 984. Yes. The other one is rent. So for rent, the accrued amount is 6963. Then we adjust rent. And the amount for rent given under the trial balance is 570, 144. So we add 6963. So this will give us 5. That is 571. 577107. Then we go to information number 2. we have the prepaid expenses. Prepayments, they are current assets. They are current assets, and we adjust them by lessing them from the amount given as the balance at the end of the year. So we have prepaid expenses. I'll say that these ones are assets. And for that case, we have rates. The amount which was prepaid was 94.20. So we adjust rates, and the amount for rates is 63.48. We less 94.20. We less 94.20. 63.48 minus 94.20. 59.28. Then the other one is insurance premium. That is insurance. It was prepaid with 10,080. So we adjust insurance. We adjust insurance. The amount given in the trial balance for insurance is 498,039. We minus 10,080. Give us 487, 959. 487,959. Information number 3, we have depreciation and respective allocation is provided as follows. So information number 3 is depreciation. And depreciation is always an expense. So if the first one is building. For building, we are told it is 2% at cost. 2% at cost. That means they were using the straight line method. 2% at cost. The cost of building is given as 390,000. So this one will give us how much? 7,800. And we are told it has been classified or allocated to administration. That means it is to be recorded under the income statement. It is to be recorded under the income statement. Then number 2 is plant and machinery. Plant and machinery. We're told it is 15% on cost, 15%, and the cost of plant and machinery is 2,190,000. 2,190,000. So we get 15% of 2,190,000. $328,500, and we've been told that it has been classified to factory. So that means it should be recorded under the manufacturing account. Manufacturing account. Manufacturing account. Then number 3, we have the office. The office equipment, we have been told it is 10% on cost, 10% on cost, and the cost of the office equipment is 330,000. This is 33. This is 33,000. It is been classified to administration. That means should be recorded under the income statement. Then we have the last one, which is motor vehicles. Motor vehicles, will be told it is 25 on reducing balance. For the reducing balance, we say rate times cost minus the accumulated depreciation. So the cost for motor vehicles is 600,000. We minus the accumulated depreciation of 240,000. Then we multiply with 25%. 600 minus 240, that is 360, right? 360,000 times 25%. $90,000. And it has been classified under distribution. So if it's under distribution, that means it goes to the income statement. That one goes to the income statement. That one goes to the income statement. So we proceed with the question. Still on the same additional information, it says rent, rates, insurance, heating and heat lighting to be apportioned in the ratio of 5:1 in relation to factory and administration. That means they have been apportioned some amount to go to the manufacturing account and some amount to go to the general income statement, and they are to be apportioned in the ratio of 5:1. So for rent, we'll take the amount it goes to factory, and that it goes to administration, right? So we have 5/6 goes to factory, and rent we had adjusted already, right? So we use the adjusted amount 577,107. 577,107, and also that one which goes to admin is a 6th of 577,107. Online, also give us your figures. 480. 922.5. So to get their 6, they just take the 577,107 minus 480, 922.5. Sorry? 96. 184.5. So that's how we apportion that amount of rent. Then the second one is rates. So also 5/6 and also a 6. To factory, 5/6 goes to factory, and we also adjusted rates. So we use the adjusted amount of 59.28. 59.28, we get 5/6 of that. 5/6 of 59.28. Online also give us your figures. 42,440. 8488. That is rates. Then the next one is insurance. We also are portioning 5/6 of insurance goes to factory. And insurance we also adjusted, so we use the adjusted amount of 487,959. 487,959. We get 5/6 of that. First one is 4/6. 4/6, that's 2.5. So the one it goes to admin itakuwa ngapi? 81. 326.5. 326.5. And lastly is the heating and lighting. The heating and lighting. 5/6 of heating and lighting goes to factory, and we also use the adjusted amount, which is 183,984. So lighting and heating 5/6 of 183,984 goes to factory.
It's 153.
153. 320.
Then it's 3664.
3664. 3664. That is additional information 3. I mean that was to be additional information 4, eh? Because I see the next one is additional information 5. Yeah, so that is additional information 4. So that now we can deal with additional information 5. Additional information 5 says the directors' salaries include 20 million paid to the production directors and office salaries of 64 to the 7,000 paid to salesmen. So this is what it means. But part of the directors' salaries, there is 20 million which is paid to the production directors. So the production directors, these are costs which has been incurred indirectly in production, right? So that means you itakuwa ni overhead. So that cost will go to the overhead under the manufacturing account. Then we have under the office salaries, okay? Included in the office salaries, there is 64,237, which is paid to sales men. So we'll adjust these two. So the first one, we adjust the director salaries. So the director salaries, we are given an amount of 9306. We minus 20,000. We minus 20,000. So that's the amount which it is specifically for all the other directors. 7306. So this amount goes to the income statement. Then the 20,000 is production director salary of 20,000. This one goes to the manufacturing. The manufacturing account. The reason why we are taking it to manufacturing account is because it has been associated with what? production. It has been associated with production. It's been associated with production. Then on the same, we have the office salaries. Office salaries. The office salaries were given an amount of 138,081. And we have been told that included in these office salaries, there is 64,237, which belongs to salesmen. 64,237. So we deduct that amount. Then we'll have salaries to salesmen. Which is the 64,237. So 138,081 minus 64,237. 73,844. Yes, and both of them, that is this office salaries, the adjusted amount, and also the salaries to salesmen, we record them under the income statement. Then we have information number 6. Allowance for doubtful debt is to be maintained at 1% of the accounts receivable. So we will calculate the allowance for doubtful debts. Then we compare it with the amount given in the trial balance. We see whether it has increased or decreased. So kama ni increase inakuwa ni expense, kama ni decrease ni income. So that is information number 6. So allow me to fix it here. That allowance for doubtful debts. Allowance for doubtful debts. So we'll have the calculated, which is 1% of the accounts receivables, and the accounts receivables were given an amount of 1.5 million. So that means the calculated will be 15,000. Then as per the trial balance, the amount as per the trial balance is how much? Which is the balance put down. Yes, the allowance for doubtful debts. I saw it somewhere. $3,000. Yes, 3,000. So as at the beginning of the year, the allowance for doubtful debt was 3,000. But now as at the end of the year, it's now 15,000, right? So it has increased from 3,000 to 15,000. So the difference is what? 12,000. The allowance for doubtful debt is on the other side. On the other side of the question. Just before the inventories, that's the opening inventories. So it has increased to 12,000, and this difference will treat it as an expense in the income statement. 1%, yes. Accounts receivables, they are given their accounts receivables and payables. Then number 7, inventories as of 31st March 2020 were as follows. Those are the closing inventories. Those are the closing inventories for raw materials and the work in progress. So then we are told the fact number 8, we are told that the factory produced 1,500 units. Only 100 units were in inventory as at 30th March 2020. So we have not been given the the closing inventory of finished goods in form of shillings, but will be given in form of units. Okay, so that means we'll need first to prepare the manufacturing account so that we will know what was the total manufacturing cost, because the total manufacturing cost is that which was incurred in order to produce the 1500 units. Then we'll divide by the 1500 units to know each unit incurred how much. Then we multiply by the 100 units which have remained in store. Okay, yes, that's how we will get the closing inventory for finished goods. Then lastly, number 9, corporation tax for the year ended 31st March 2020 is estimated to be 100 million. So that one will put it under the income statement, that is the statement of profit or loss. So I think now we can proceed directly to the manufacturing account. We prepare the manufacturing account. The manufacturing account. So we have TAM Limited. TAM Limited. We have TAM Limited. Manufacturing account. For the year ended 31st March 2020. So we start with raw materials. Gather in thousands. So we start with the opening inventory for raw materials. Opening inventory for raw materials, we're given 210,000. Then we add the purchases of raw materials. Purchases of raw materials were given 1,555,800. I didn't see any carnage inwards. There was also no return outwards. I only saw return inwards. That one affects sales, so it ended up our income statement. So if those items are not there, that means you less the closing inventory, which is given in additional information 7, 56,200. And this will give us the raw materials consumed. So we have 210 plus 1,555,800 minus 56,200. We get the amount of raw materials which was incurred. How much? 1 million.
You add 210.
We have 210,000 plus 1,555,800 minus 56,200. Online, give us your figures. Unless you are not with us. 1,709,600. Then we add the direct labor, which is given as manufacturing wages. We add the manufacturing wages, and we are given an amount of 1,504,200. 1,504,200 We don't have royalties there, so, and I didn't see any other direct cost. So the total of that will give us the prime cost. So it will give us the prime cost, and this will be 3,213,800. That is the prime cost. That is the prime cost. Then from there we proceed to the area of overheads or the indirect costs. So we can start picking them. We can start with the factory power. You see factory power. Factory power 90,042. 90,042. Then we have maintenance, that is maintenance of plant. Maintenance of plant 120, 189. All right, so we proceed to the informations now. We pick their portionings, right? So we pick rent. Rent, we pick an amount of 480. 489.22.5. Next is rates. We pick rates, an amount of 42,440. The next one is insurance. Insurance we pick 406. 632.5. Then we pick heating and lighting. We pick heating and lighting 153,320. Then we pick production, director salary, production director salary. Of 20,000. From there, we will pick depreciation. We have depreciation. And the depreciation is only for plant and machinery. Which is 328,500. 328,500. And I believe we have not left any other overhead. Let's cross check. So there's no other expense or cost which is associated with manufacturing or the factory. So from there, we less or we add first, we add the opening inventory of work in progress. So we add opening work in progress. Add opening work in progress, which is given up there as 378,000. Then we less the closing work in progress. The closing work in progress given in information number 47, 190. 190. So we add all these costs from prime cost. We take the prime cost. prime cost, we add all these costs, then lastly we less the closing work in progress. We less the closing work in progress. And that will be the manufacturing cost.
Fifty 66.
50, 66,
467.
467. Anyone else with a different figure online? Okay. So that means our figure is correct, so we continue. We continue. So that is the total manufacturing cost. So we can go back to additional information 8. They produced 1,500 units. That means they incurred 5,066,467 to produce 1,500 units. So how much did they incur to produce just one unit? Right? Yes. So production cost per unit, or just the unit cost. The unit cost will be equal to the manufacturing cost divided by the number of units, which is 5066, 467 divided by 1,500, which is how much? 5066, 467 divided by 1,500. 377.64. I think we can just forward. Just that. All right, so to the smallest. So now we know that one unit was costing 377.64. So, and we are told that out of all units that they produced, 100 remain in store. So what was the cost of the units which remain in the store? Because inventory is valued at cost, okay? We value inventory at cost. So the closing inventory of finished goods will be the unit cost times the number of units which are in store, okay? Yes, so closing finished goods, closing inventory of finished goods will be the unit cost, which is 3377.64, to multiply with 100. Multiply with 100, and that one will give us, 3377.64. That is 337,764. So this is the closing inventory for finished goods. This is the closing inventory for finished goods. 337,700. And 764. So that is the manufacturing account. That is all from the interpretation of the additional information. All that. So that's how we prepare that manufacturing account. So we continue. Now we go to the income statement. That is the statement of profit or loss for the year ended at 1st March 2020, and it's for the term limited. So for the income statement, we start with sales and the amount of sales. We are given 7,804,441, and there are sales returns. So we less return inwards. Less return inwards of 45,318. And we will have the net sales. So we have sales of 7,804,441 minus 45,318. 45,318. 7,755,123. Then from there we less the cost of sales. Less the cost of sales, whereby we start with the opening inventory of finished goods. So you can call it opening finished goods. Opening finished goods were given 750,000. Then we add the manufacturing. We add the manufacturing cost, 5,066,467. Then we less the closing inventory for finished goods, less the closing finished goods, which is 337,764. So we have 750,000 plus 5,066,467 minus 337,764. So that one will give us an amount of 337,764. 5,478,703. Then we less that amount from the net sales. We less that amount from the net sales, and that will give us the gross profit. The net sales 7,755,123 minus the cost of sales of 5,478,703. $420. 2,276,420. Then from there, we check whether we have any other incomes. And I didn't see any income. So we less expenses. with less expenses. And for the expenses, we can pick the ones which are just direct. The expenses that hazihitaji adjustments. So we have general administrative expenses. General administrative expenses, general admin expenses. 183,033, 189, sorry. 189,033. Then we continue, we have bank interest. We have bank interest 21,210. 21,210. We continue. Before we pick the ones that we adjusted, we have advertising. The advertising expenses 155,13. 155,13. Then on the other side we have transport expenses. The transport expenses we have 255,039. Then from there now we pick the expenses that we had adjusted. So we start with tuanzie pale juu, we have the office salaries. Office salaries we adjusted to how much? 73,844. Then out of the office salaries we picked salesmen salaries. We picked the salesmen salaries of 64 to that 7. Then we proceed to insurance. To insurance are 6. A 6 nilikuwa inakuja hapa. What was the 1/6 of insurance? Insurance 81,326.5. The next one is rates. Rates, the 1/6. Rates, the 1/6. 84.88. The next one is rent. The 1/6 of rent. And the 6,184.5. Next is directors' salaries. The directors' salaries we adjusted. We deducted 20, so it remains 7306. Then we have heating and lighting, 1/6. Heating and lighting, 1/6. 3664. To the other side, we have now, let's pick allowance for doubtful debts. Information number 6. It increased with 12,000. That's all. Then from there, we pick depreciation. We pick depreciation, and depreciation it acquire buildings. Depreciation ya buildings ni ngapi? 7,800. The next one is office equipment. $33,000. And lastly, motor vehicles. Motor vehicles, 90,000. Two vehicles, 90,000. So we proceed. Let's see whether there is any. Whether there is any expense that you have left behind. We cross check. And I think there is none. Yes. I don't see any that we have left behind. So that means the gross profit minus all these expenses to give us the profit before tax. Gross profit, kutoka hapa we less all this up to depreciation of vehicles, we get the profit before tax. We get the profit before tax. So profit before tax, 1082, 775. 1082, 775. Then we less tax. Then we less tax, which is 100,000 less tax 100,000 less tax 100,000. We get profit after tax. Just 982, 775. Then lastly, we add the retained profits. We add the retained profits, which is there somewhere retained profits of 127,425. Then lastly, less those interim dividends which were paid, less the interim dividends of 30,000. We are not told that we are not told to calculate. We are not told whether there was any recommendation or proposal of final dividends. So that means at the end of the year, this will be the retained profits for Tamu Limited. That will be the retained profits for Tamu Limited. 1090, 200. 1090, 200. 1090, 200. that is the factoring account, the income statement, and the statement of profit or loss for Tamu